This is Quint Bilo discussing the calculations and journal entries needed for bond payable accounting, a long-term liability. I'll also include any amortization adjustments entries as well. So we're looking at entries related to the issuance of bonds, talking about entries to obtain cash, making interest payments, recognizing interest expense, and possibly writing off certain adjustments related to discounts or premiums. Just to review the selling price of bonds, there can be three different scenarios for the pricing of bonds. They can be sold at face value, which is the simplest accounting. They can be sold below face value and sold above face value. Each scenario has its own accounting entries. Whatever price a specific bond sells for, the interest payment made is the same. This is fixed based on the coupon rate and the face value of the bond. Reviewing the three scenarios in which bonds can be sold. First, it's based off the contractual rate of interest that are on the bonds. In this case, we're using 10%, and the current market interest rate that's demanded by bondholders. That will determine the selling price of the bonds. If the interest rate, the current market interest rate, is lower than the contractual rate on the bonds will be very attractive and will sell at a premium. If the market interest rate equals the contractual bond rate, the bonds will sell at face value. If the current market interest rate is higher than the contractual interest rate on the bond will not appear attractive unless it's discounted, the price being lowered. The 10% coupon bonds will sell, it's just a matter of what price they will sell at. Question: the rate of interest investors demand for loaning funds to a corporation is called the contractual rate, the face value rate, the market interest rate, or the stated rate? The answer is the market interest rate. That can vary daily. It's a key driver in determining the selling price or issuance price of a bond. Another question. Carson Inc. issues 10-year bonds with a maturity value of $200,000. If the bonds are issued at a premium, this indicates what? Now, selling at a premium, we're talking about the buyer paying more than the face value. If the buyer is paying more than the face value, that means that coupon rate is higher than the rate of the market is currently demanding. So the contractual interest rate exceeds the market interest rate. Coupon rate appears very attractive. Buyers will pay a premium for that. But it equalizes the two rates, the market rate and the coupon rate. Let's start with a simple case, issuing bonds at face value. On January 1st, Candlestick Inc. issues $100,000 5-year 10% bonds at 100. That is, 100% of face value is the selling price. Let's record the entry for this sale or issuance of bonds. Debit cash, $100,000 for an asset received. Credit bonds payable, $100,000. Assets increase with a debit, bonds payable increase with a credit. Continuing the illustration, on these $100,000 bonds, 6 months later, when interest is due, and interest payable semi-annually is common, let's prepare the entry to record the payment of interest, assuming no previous accrual was made. On July 1st, we'll debit interest expense, $5,000. We'll credit cash, $5,000. Cash goes down, interest expense increases and lowers the equity portion of the balance sheet. Here's a calculation for the $5,000. It's based on the face amount of the bonds times the coupon rate, 10%. Calculated a $10,000 annual interest cost. Divide that by 12. Multiply times 6 months to arrive at $5,000 for a 6-month period. Now let's move to year end. Same example. interest is payable on January 1st and July 1st. But at December 31st, one day before interest is due, we want to issue financial statements. Those financial statements need to be updated for all financial conditions, including interest earned by bondholders. Let's make a calculation. I'm going to debit interest expense at December 31st, $5,000, and credit interest payable, not cash, interest payable, $5,000. This will be paid the next day on January 1st. Note that we are not making an interest payment at December 31st year-end, but we need to get the financial condition accurate before preparing financial statements. Interest is earned, just not paid as of year-end, December 31st. On the very next day, January 1st, Candlestick makes payment against the previously accrued interest one day earlier. Debit interest payable, reducing it $5,000. Credit cash $5,000, reducing cash, paying the prior accrual. Again, the expense entry is made the previous day to get the financials right. We only need to reduce that accrual when paying it the next day. This is a balance sheet entry only, removing the accrual. Nothing affects the income statement for this particular payment. Let's move to a case of issuing bonds at a discount. That is, they're not sold for face value. We'll be introducing a new account here called Discount on Bonds Payable. Its normal balance will be a debit balance. On January 1st, 2014, Candlestick Inc. sells $100,000 5-year 10% bonds for $92,639. That is 92.639% of face value. Interest payable July 1 and January 1. Let's first make the entry to record the issuance of these bonds for a selling price of $92,639. We'll debit cash. The proceeds are selling price, $92,639, increasing cash. We'll debit this new account called Discount on Bonds Payable, $73.61. This is the amount that we did not receive based on face value. It's a debit value account. We need to document what the corporation did not receive upon the bond sale. Why? Because the bonds payable account will be booked at the full face value. That is, bonds payable is recorded at $100,000 credit, increasing that liability. It's always recorded at face value. That's the amount that's owed at maturity. Let's take a look at these two liability accounts, bonds payable and discount on bonds payable. The discount account modifies the bonds payable account. They go together on the balance sheet. Here's an example of the balance sheet for Candlestick Inc., a partial balance sheet. The long-term liability section just showing the transaction we just recorded. Now, at the time of issuance of the bonds, their proceeds, $92,639, equals the total net liability of bonds. It's comprised of a bonds payable account, always stated at face value, no matter what the selling price is. And our discount on bonds payable account, a modifying account, has a debit balance contra to this bonds payable account for a net credit balance of $92,639. The sale of bonds below face value will cause the total cost of borrowing to be more than the bond interest paid to bondholders. Why is this the case? The borrower is required to pay the bond discount at the maturity date to bring the full payment up to face value. The issuer of the bonds will owe $100,000 to the buyers, not $92,639. Thus, the bond discount is considered to be an increase in the cost of borrowing. By the way, note that the discount on bonds payable account is called a contra account because it is a deduction from the main bonds payable account. Now, our selling price was below face value, but 5 years later, these are 5-year bonds, at maturity, the face amount is due to the bondholder. We're not just returning the selling price if it's below face, we're returning the full face value of the bonds. They are payable at maturity. This is part of the bond indenture contract. This discount at time of sale affects interest yields. It does not affect the principal amount due at maturity date. So the discount not received by the corporation becomes an added cost to the issuer or corporation of the bonds. Again, let's look at the balance sheet presentation of the bond payable. Bonds payable at face value, $100,000, less discount on bonds payable, $73.61 for a net of $92,639. Now, over the life of the bonds, we're going to get rid of that discount on bonds payable account. The $7,361 account will be reduced to zero over the life, because when the life of the bonds is completed, we only owe the $100,000 in the bonds payable face value account. So we're going to get rid of that account by systematic journal entries. Over the life of the bonds, or 5 years, we'll systematically eliminate those discount on bonds payable account. The debit in this account, in effect, will be zeroed out and transferred. Will it be transferred to? A debit in the interest expense account. It represents an increase in the cost of borrowing to the corporation, an added payment later at maturity. But we'll be booking this as we go along, as we make actual interest payments to the bondholder. Crediting that discount on bonds payable account, reducing it, and transferring that debit to interest expense, added cost of borrowing. Let's look at this total cost of borrowing two different ways. As we indicated, the bonds are issued or sold at a discount. They were sold at less than their face or full value of $100,000. Now, what are the payments that will be made by the issuer to bondholders over the life of the bonds? A total of $50,000. $100,000 face value times 10% annual rate. Interest expense is paid on a semi-annual basis, so times 1/2, so $5,000 every 6 months. So $5,000 times 10 periods. Where the 10 periods come from? They're 10 interest payment periods because the interest is paid semi-annually twice a year over 5 years. So $50,000 is the total payment of interest that bondholders will receive. Now we're going to add that bond discount amount of $73.61 to come to a total cost of borrowing of $57,361. Let's prove that out in a different manner at the bottom. Again, the principal at maturity, face value, $100,000, will need to be paid back at maturity. And along the way, the issuer will be making semi-annual interest payments totaling $50,000 over the life of the bonds, or a total of $150,000 we cash paid to bondholders. How much did the issuer receive upon issuance of the bonds? $92,639, the selling price. So total cost of borrowing is simply the total paid out versus received at time of sale. The issuing corporation over the life of the bonds will pay out $150,000, but they received $92,639 at time of sale. The difference is the total cost, $57,361. Let's examine how we transfer the discount to expense, the debit discount on bonds payable into interest expense. As mentioned, the buyer of the bonds has paid less than face value, but the issuer of the bond will be paid back the full face value at maturity. So the discount is on the books of the issuer. Here's the T account diagram of the entry we made upon issuance of the bond. We received cash of $92,639, a debit that increased it. We credited bonds payable, $100,000. We'll owe that at maturity. And to true up our entry to make it balance, we need another debit of $73.61. That's a debit to the discount on bonds payable account. The discount will be partially removed each time an interest expense entry is made over the life of the bonds. We use a straight line method. There are others. The straight line is demonstrated in the appendix to Chapter 15. So the discount is amortized, another word for being written off, over the life of the bonds. Now the bonds are a 5-year life with semi-annual interest payments. So we have 10 periods of time to write off the discount amount of $7,361 that appears in the discount on bonds payable account. Each time interest expense is recorded semi-annually, 1/10 of the discount amount will be removed and transferred to the interest expense account. It's an additional cost of borrowing. The debit in this discount account becomes an additional debit in the interest expense account systematically over a 5-year period. Let's watch how the amortization entry occurs. First, how much interest are we paying? 10% annual coupon times the face amount of the bonds, $100,000, divided by 2, semi-annual, is our fixed payment every 6 months, $5,000. So we're going to credit cash, $5,000, reducing it. This is paying interest to the bondholders. We're going to make this amortization or write-off entry of the discount account. We're going to credit that account. It's got a debit balance. We're going to credit it. Discount on bonds payable, 1/10 of that $7,361. And lastly, we'll debit interest expense. What's the amount? We're calculating that last. Simply add up the cash we paid and the credit to discount on bonds payable. Totals $5,736. That's our interest expense derived from this entry. You can see that the recognized interest expense is greater than the cash paid to bondholders because the corporation, the issuer, is slowly getting rid of this discount account over the life of the bonds, transferring that debit of the discount account into the debit into interest expense. Now, the interest expense is increased beyond the fixed interest payment as we've seen. This is because the face principal amount is eventually what will be paid back, not the original proceeds of the sale. That $736 write-off adjustment you see as a credit to discount on bonds payable will be made every 6 months as we make interest payment entries to bondholders. So the difference in selling price versus face value modifies the recognized interest expense number. Now, this works similarly for selling prices that are premiums, where buyers are paying more than the face value at purchase. They will not receive that premium back, so interest expense is lower than the fixed interest payment. Just an opposite effect, reducing interest expense. At maturity time, the contract obligates the issuer to pay back the maturity value, not an amount they received in excess of that maturity value, not a premium. That premium will decrease interest expense, and we'll show that in a later example. Redeeming bonds at maturity. We're at the end of the life. What's the entry that's recorded? Assuming that the company has paid and recorded all its interest expense entries for the last period, all that's left is to redeem the bonds at maturity. Debit bonds payable, reducing that account. Credit cash, $100,000, reducing cash. This redeeming entry, paying back the principal or face amount of the bonds, closes out our accounting. Any discount on bonds payable account was already reduced to zero systematically along the way each time an interest payment was recorded. So all that's therefore left is the face amount of the bonds payable account. We retire it. Reduce it by paying cash back to the original bondholders. Review question. The discount on bonds payable account is a contra account. It reduces the net position in the long-term liability section of the balance sheet. It's netted against the face value in bonds payable. So discounts are deducted from the face value of the bonds in the liability section of the balance sheet. Now let's switch to issuing these same bonds at a premium. In other words, the marketplace is different upon issuing these bonds. We're going to sell these bonds on January 1st for $108,111. That is 108% of face value. Interest is again payable on July 1 and January 1, so the entry to record the issuance will be as follows. By the way, note that we have another new account here called Premium on Bonds Payable. its normal balance will be a credit balance. Let's see how that works. We sell the bonds for $108,111, debit cash increasing it, the proceeds of the bonds issue. Credit bonds payable, always at face value, $100,000 credit increases the bonds payable account. And to chew the entry up to make it balanced, we need additional credit entry, and we'll make that to an account called Premium on Bonds Payable, $8,111. We have a balanced entry here. Again, that Premium Bonds Payable is a credit balance account. We need to document what the corporation received upon the bond sale. In this case, it was more than face value, $8,111 beyond face value. Now, looking at the balance sheet presentation of this transaction after its recording, we see the bonds payable at face amount, credit of $100,000. The premium bonds payable is also a credit balance account, total of $108,111. Again, right after the issuance of the bonds, the long-term debt related to that will equal exactly the proceeds for the sale of the bonds. Now, in this case, the sale of the bonds above face value causes the total cost of borrowing to be less than the bond interest paid. Just the opposite of this discount example. The reason the borrower is not required to pay the bond premium at the maturity, only obligated to pay the face amount in the bonds payable account. Therefore, the bond premium is considered to be a reduction in the cost of borrowing. We will reduce interest expense over the life of the bonds when a premium is involved. So again, at maturity, we just owe the face amount to the bondholder. We're not returning the selling price above face, only the face amount. So this premium at time of sale affects interest yields, not the principal amount due at maturity date. So the premium becomes a lowered cost to the issuer of the bonds. Again, looking at the balance sheet presentation, right after time of issuance of the bonds, $108,111, because that's exactly equal to the cash obtained by the company in selling them. We will get rid of, we'll amortize, we will write off this premium on bonds payable over the life of the bonds, systematically. So we'll make journal entries that will reduce the premium account. We'll, in effect, credit, or rather the credit balance in this account will be zeroed out and transferred. Transferred to what? Well, it'll reduce the normal debit in interest expense. It'll lower the interest expense. It represents a decrease in the cost of borrowing to the corporation because we are paying back less than the selling price at maturity. Again, let's look at the total cost of borrowing in two different ways. First of all, the bonds, even though they issued a premium, the interest payments will be fixed. It's based on coupon rate times the face amount of the bonds. $50,000 over the life of the bonds over 5 years. Again, that 10-factor calculation is a matter of $5,000 made every 6 months, so a total of 10 interest payments over the life of the bonds. The bond premium, $8,111, will reduce that cost of borrowing to the corporation, come down to $41,889. Let's look at that in a different manner at the bottom. Again, the principal at maturity, $100,000, that will be paid back. And over the life of the bonds, the issuer will pay $50,000 to bondholders, total of $150,000. What was the cash that the issuer received from the bondholders when it was sold? $108,111, selling price. So again, let's look at the difference between the total that will be paid out by the issuer versus the amount received at the time of sale by the issuer. $150 less $108,111, $41,889, total cost of borrowing over the life of the bonds. Again, looking at a T account and seeing how this premium is adjusted to expense. The premium is on the books of the issuer. Premium on bonds payable is a credit account. You recognize this is the entry made upon sale of the bonds or received $108,111, paying back the face amount of $100,000 at maturity. We need that credit in premium bonds payable to chew up or balance the journal entry upon issuance. This premium will be partially removed each time an interest expense entry is made. Again, we'll use the straight line method. So let's answer the question, what's the total interest expense recorded? First of all, how much interest are we paying every 6 months? $5,000. Coupon rate times face amount minus 1/10 of that premium, $811. In other words, our interest expense will be $41.89. Let's develop that entry one line at a time. First of all, we're paying cash. Credit reduces cash $5,000 every 6 months. Secondly, let's begin the write-off of the premium amounts payable account. We will debit that account. It has a credit balance. 1/10 of that will be taken out every time we make an interest expense entry, and we will develop our interest expense $41.89 number last, debit interest expense. A question for the premium on bonds payable account. Does it have a debit balance? Is it a modifying account? Is it deducted from bonds payable? Does it increase over the term of the bonds? It's a modifying account. It modifies the bonds payable account. It increases the net position in long-term liability on the balance sheet. It is added to the face value of the bonds. It's not called the contra account since it's an addition to the parent account, not a deduction. So premiums are pluses or additions to the face value of bonds, again in the liability section of the balance sheet. Let's make the entry to redeem the bonds at maturity when they're issued for a premium. Again, assuming that along the way we've made all the interest expense and amortization entries, including the last interest period. So all that's left for Candlestick is to record the redemption of its bonds at maturity as follows. January 1st, debit bonds payable, $100,000, decreasing that account. Credit cash, decreasing that account. This redeeming entry, this paying back the principal or face value, closes out our accounting. Any premium on bonds payable account was already reduced to zero systematically along the way, each time an interest amount was recorded. And again, all that's left is the face amount in the bonds payable account. You will recognize that this redeeming entry is the same redeeming entry we made when the bonds were issued as in a discount mode. That's because only the bonds payable is left, the face value is left. The redeeming entry is always the same, irrespective of the selling price of the bonds originally. Let's discuss carrying value of the bonds. What does this mean? The carrying value is the net value of the liability on the balance sheet for the bond offering. It's the face amount of the bonds in the bonds payable account. That account is always at face value, less any remaining discount on bonds payable, or plus any remaining premium on bonds payable. Either one or the other, not both. Net carrying values always move toward the face value of the bonds. Why? Because any associated discount or premium is being written off over their life, leaving the bonds payable account at face value alone at time of maturity. So when bonds are initially issued at a discount, the carrying value is lower than the face value. And that discount account is removed, the carrying value moves toward the face value. Bonds issued at a premium, the original total net liability is higher than the face value. As the premium is written off, the carrying value moves down to face value over the life of the bonds. Just a graphic, the face value of bonds payable account, deducting any discounts on bonds premium or adding any premiums on bonds discount equals the carrying value. Over the life of the bonds, that discount or premium account will become written off. We call that amortization. They'll be zeroed out. And all that remains then is the face value at time of redemption at the end of the life of the bonds. Again, either one or the other condition exists for a particular bond offering, not both simultaneously. Review question. As bonds are about to be redeemed at maturity, the carrying value of the bonds will be the face value of the bonds. The face amount is what's paid back to bondholders at the end of the bond contract. Before we do a review of the interest expense calculations, just a reminder that the straight line method that we use to amortize any discounts or premiums, that means that the discount or premium amount that's removed is the same amount for each periodic interest payment. Straight line, same amount each interest period. Now, a word of caution. If there's a need to accrue interest expense between the periodic interest payment periods, the values will be prorated for the time period involved, both the interest expense and the amortization of any discount or premium. We're talking about periods of less than 6 months. We pay interest every 6 months, but what if our financial statements need to be prepared between interest date payments? We need to make a pro rata accrual of those values before we pull off the financial statements. Accruing interest between the periodic payments, called proration. Let's do an example here. Interest is paid semi-annually each April 1st and October 1st. By the way, interest can be paid in any 2 6-month periods based on when the bonds are issued. It doesn't have to be January and July. It could be any different 6-month periods. So year-end December 31st requires a 3-month accrual of interest owed since October 1st. If we make payments on April 1st and October 1st of interest, we have October, November, and December of interest that is earned at year-end. This 3-month partial amortization of discount premiums must occur, as well as a recognition of interest expense for that 3-month period. Now, we use the same accounts, just not use cash. We're not paying cash. We're between interest payment periods. We're going to debit interest expense, credit interest payable, not crediting cash. And likewise, we'll be writing off a premium account, which is normally a credit balance. We'll be debiting a premium if it exists. A discount account, normally a debit balance, we'll be crediting that. Those last two entries are an amortization, one or the other. So we have a 3-month interest accrual on the first entry, coupled with a 3-month amortization adjustment affecting interest expense on a premium account or discount account, one or the other. Proration. It reviews the bond discount, and bond premium scenarios that we went through. It shows it in a table here. Accountants would actually use a discount amortization table to systematically reduce the discount amounts over the life of the bonds. You'll recognize that we pay interest, column A, $5,000 every 6 months. That 5% rate is the 10% annual coupon rate divided by 2, because it's paid every 6 months, so effectively 5% every 6 months. The discount on bonds payable of $73.61 is amortized 1/10 every 6 months, or $736. And so the last thing we calculate is interest expense, column B. The cash we paid out, $5,000, plus the debit we transferred, interest expense, $736, total interest expense every 6 months, $5,736. The discount on bonds payable account, column D, will be reduced over the life of the bonds systematically. And we see here in column E, the carrying value of those bonds issued at a discount is slowly increasing. It's increasing toward face value as the unamortized discount amount is lowered each time we make an interest payment. Here's a journal entry on July 1st, 6 months later after the bonds are first issued. You've seen this entry before. Let's review it one more time. We're paying interest expense of $5,000, a 6-month calculation of interest, 10% times $100,000 divided by 2. Every 6 months, $5,000. Here's discount on bonds payable amortization entry, $736, credit to that debit balance account. That causes our interest expense to be higher than what we paid, or $5,736 debit. We calculate interest expense last because of the amortization of the discount. Likewise, same bonds but issued at a premium, a different market. In effect, by issuing at a premium, that tells us that the debt contract carried a higher or more attractive interest rate versus the current market. So buyers were willing to pay a premium over face value to obtain the current market yield rate. When bondholders buy bonds, they're always after the market interest rate. So we see the discount or the premium account, the unamortized premium is a credit account. We will slowly move a credit from that into interest expense, $811, 1/10. Again, you recognize column A, we pay $5,000 every 6 months, less the $811 premium amortization. Column B, calculated last interest expense, $41.89 every 6 months. So the unamortized premium is moving down from $811 systematically down. As that modifying account goes down, the bond carrying value account also goes down, because the face value of bonds is added to the premium credit account at time of issuance. So as we reduce the amortized premium, that bond carrying value moves toward the face value over the life of the bonds. Illustration of the journal entry of recording interest expense 6 months after the bonds were issued at a premium. Again, payment of interest is always fixed, $5,000. 10% times $100,000 times 1/2 year, $5,000. Credit cash, reduce it. We will debit the premium bonds payable account. It's normally a credit balance account. We are amortizing, writing it off, 1/10, $811 debit. That brings it down. Last entry, interest expense, $41.89. $5,000 less $811. $41.89 is recognized interest expense on this particular bond issue every 6 months.